Hey, what's up, everyone? Welcome back to my world of stocks and welcome back to my 3 stocks on sale series for the month of March 2025, where I give you 3 new stocks every month that I feel are on sale right now at the moment, looking attractive for the long term. To make things even more fun and interesting, I specifically choose one lower risk, one medium risk, and one higher risk option to give you even more variety. And just a heads up, this month in particular, it's also going to include a brand new pickup, a new stock that I'm buying for the first time ever and that I've never even covered before on the channel. So you're not going to want to miss it. But as always, just please do your own research and make your own decisions. Starting with the stock number one, the lowest risk option first. Well, guys, I cannot believe that we have such an amazingly strong company falling right now in Google, ticker symbol GOOGL, who in my opinion is heavily being oversold at the moment, with the stock actually losing close to a fifth of its entire value just in the past month alone. And guys, it is very rare to get a dip on this one. So when it happens, you can bet that I'm buying it very fast, and especially in this particular moment because it happens to be now cheaper than the sector on a PG ratio basis. And you'll have to explain to me how in the world a massive company like this doing over $300 billion in revenue per year and is still somehow managing to grow at a double-digit rate with unbelievable profits too, should be anywhere close to the same price as the sector, let alone actually cheaper than it. And of course, all of those financials are the result of an amazing business that primarily dominates virtually every internet-based market out there, with number one market share in search, internet browser, mobile OS, mapping and navigation, video streaming, email, and even number 3 in cloud computing, meaning that they not only know everything you do online, but they have the means to collect, store, and process all of that data too, which, by the way, will very likely be the lifeblood of artificial intelligence long term, a market that will easily be worth trillions of dollars in the future. Speaking of which, one of the most exciting things about Google's technological advancements right now is their new investments into quantum computing, something that I think will probably fuel the next big wave of AI hype. They claim that their new Willow chip can solve complex problems in only 5 minutes that would otherwise take the world's fastest supercomputers 10 septillion years to complete, a number that most people can't even fathom. Now, how much of that promise and hype will really come to fruition, still remains to be seen, which I also predict that it's going to take years until we really start witnessing the true power of quantum computing. But it's really just another example of how Google continues to push the boundaries and invest in new areas for growth rather than just coasting, becoming complacent on an already dominant business that they already own and they could just kind of coast with. Which, by the way, many would argue that it's not even fair to smaller competitors for Google to still be competing as a whole because of how dominant they are, and they should therefore be broken up into smaller pieces, like with Cloud, YouTube, Android, Chrome, Search, Waymo, Verily, Calico, DeepMind. But even then, as Alphabet shareholders, we would still get all of those individual pieces from a breakup, all of which I would love to own myself too. And because of that, I just see very little to no risk in owning the overall giant behemoth of Alphabet. It's probably the best overall stock in the entire market, and considering the recent dip, you can bet that I'll be buying more in the coming month too. I like Alphabet as a whole overall, and even if it got broken up in the future, I pretty much want to own every business they have anyway. All right, moving on to stock number 2. This will be our medium risk option, and this month I'm going with a heavily beaten down stock that is actually a market leader, and they pay a nice dividend too. So kind of a unicorn here. You don't get these too often. And I'm talking, of course, about Scotts Miracle-Gro, ticker symbol SMG. Now, like I said, this is a market leader. They're number one in the entire world for garden and lawn care products. And really, when it comes to their bread and butter, soil and dirt products, along with everything else they sell in that kind of, garden section of your local Walmart or Home Depot, well, I don't think anyone else even comes close to their brand strength. I mean, you could throw any random person into that section and tell them, pick out any bag of soil that you want. You can take it home with you, pick out any one. The highest quality, the most premium, 99% of the time, I think that they're coming back to you with a bag of SMG. And the same goes for any adjacent products too, like plant food, fertilizer, pesticide, whatever else, they're most likely choosing Scott's Miracle-Gro because of them being the highest quality. And yet, with so much clear dominance and brand recognition, why then has the stock actually crashed into the ground recently, losing close to 80% of its entire value from the top and actually leaving it negative over the past 10 years too? Well, there's three primary reasons that I feel will actually not really matter so much going forward, and thus I'm buying more of the stock in my own portfolio because of it, and here's why. So first of all, the recent crash is coming off of a gigantic surge that they saw during the pandemic, where everyone was staying home with nothing to do, and many even had extra disposable income from the government, which they decided to use on home project and renovations, thus sending SMG's financials soaring to new record highs and the stock right along with it, to levels that really it shouldn't have been trading for to begin with. That's number one. Now, number two is that the can market turned out to be a bit of a disaster. Now, I have to use code words here on YouTube, but basically what happened is that a ton of hype entered the can market, which everyone was, expecting federal legalization to send demand soaring higher than supply, and that, along with everyone wanting to grow their own can as well, resulted in a lot of that hype also spilling over into Scott's Miracle-Gro, who, by the way, also owned themselves a subsidiary for the can market called Hawthorne and sold various products for growing can. But unfortunately, what we actually ended up seeing was more suppliers in a crowded market with oversupply and deteriorating margins that sent even the most popular can stocks crashing too, like Canopy Growth, for example, who saw their stock lose over 99% of its value from the top. I mean, it just got absolutely decimated. And again, most can stocks right along with it. But all of these moving parts as a whole kind of led to reason number three, which is that SMG's financials overall deteriorated coming off the pandemic. It's a time that we've also been experiencing sky-high inflation. It also hurt premium brands because of people choosing cheaper alternatives, ends up hurting their margins. And as a result, their sales came crashing down, with their profits actually turning negative too for the first time in years. However, here's where the opportunity comes in, because what we're left with now is a dirt cheap valuation at a PEG ratio of less than 1. Now, for context, the sector median is currently 1.4, meaning that SMG is actually 50% cheaper than the sector, despite them being a market leader. And moving forward, profits are recovering and sales have already stabilized and are back to a higher level today than they were before the pandemic ever happened. And yet during that time, the stock price has actually been cut in half. So basically, this is a great market leader that is recovering back up to their former glory, but that I can still get the stock for a much cheaper price than it's ever traded for. Which, on top of all of that, the stock also pays me a really nice dividend yielding close to 5%. That's extremely attractive for a value kind of rebound play here that I think can recover. Obviously, the risk right now is coming from the state of the economy and our real, high inflation, high interest rates, which could cause more damage if those things linger longer than expected. But longer term, I would still be a buyer of this one regardless, and I own it myself. Okay, that's going to leave us now, though, with the final stock of the list, the highest risk option of all, and what is actually a brand new pickup of mine as a very high risk, very speculative play for the future. So you've been warned. But that stock is a nuclear energy company called Oklo, ticker symbol OKLO, which up until now I had held off on because of how much it already soared after doubling in price just this year alone. However, that price has finally started to fall again, losing almost 30% of its value in the past month, which was enough to convince me to dip my toes in just in case it takes off in the distant future. Now, it is still up around 175% since IPOing last year, but considering the future potential of nuclear energy, that might not be as big of a concern to me long term. See, we all know that AI is going to basically be involved in just about everything we do in the world in one way or another. And with all of that massive computing power, will come just as large energy demand too, which our current grids and infrastructure are nowhere close to being able to meet that demand, let alone, even do it in any kind of clean way that would satisfy all the climate activists that hold a ton of influence these days. And for a while now, I've been saying that really the biggest bottleneck to the world advancing in AI, it's going to be energy. It's a big problem that you can bet companies and governments all around the world will be happy to spend trillions of dollars in solving. Well, that's where nuclear comes in, which isn't without its own controversies, obviously, but in terms of generating massive amounts of energy with very low emissions, there's probably nothing that comes even close to nuclear at the moment. Maybe in the distant future, we discover some other new technology or way of doing it. But right now, the answer is most likely going to be nuclear, which I think whoever is going all in on it from the beginning is probably going to see the biggest gains from it. Well, Oklo is doing just that by developing microreactors that run on metallic uranium fuel, which is denser and even cheaper to fabricate than traditional uranium fuel pellets. I know most of you may find that to be a bit confusing, but the end result is that Oklo's technology is, again, denser, cheaper, and even produces less carbon emissions, the absolute lowest available in the market, compared to traditional nuclear power plants that actually emit quite a bit more than them. For example, Oklo's flagship microreactor called Aurora only costs around $70 million to produce and can generate 15 megawatts of electricity. Well, for context, the construction of a traditional nuclear reactor could cost north of $100 million and still put out a similar output. Not to mention that Aurora's reactors are designed to be scaled up as needed and can operate for more than a decade without needing to be refueled because of their recycling technologies. And because of all that, analysts think that Oklo's reactors may have an easier time passing regulatory hurdles, which, oh, by the way, one of the biggest reasons why I like Oklo more than most of their competitors is because Sam Altman, the CEO of OpenAI, is actually the chairman of Oklo's board of directors too. Well, in case you missed it, Altman was also recently selected as a key partner for Trump's new project Stargate that will invest up to $500 billion on AI infrastructure in the coming years. And if there's one president that is known for deregulation, it's definitely Trump. So for Oklo to have all of those ties to people so high up in AI and the government, I think bodes very well for their future and for getting over those regulatory hurdles. But why then would this be considered such a very high risk stock to buy right now? Well, that's because Oklo doesn't expect to bring its first reactor online until 2027, meaning that I have to buy the stock at today's prices, north of a $4 billion market cap, for what they can potentially do years from now. Now, they do have, of course, contracts and they have a pipeline and different agreements for the future. But overall, I think what it means is that I'm going to see a ton of volatility along the way, with probably some surges in the stock, but also many crashes too. And thus, I'm only investing a very small amount to begin with. And it's with money that I can afford to lose because I do acknowledge the risk. But long term, I'm growing more and more excited about the future of nuclear energy, the more research really that I do on it. So I'm happy to at least just start dipping my toes in one of those nuclear energy type of stocks. And I happen to like Oklo the most at the moment. But hey, what do you guys think? I'd love to hear your thoughts down below. Do you own any of these stocks? What do you think about them? Or what other stocks are you buying? Let me know. I may include them in a future video too. Hey, thanks again for stopping by, my friends. I really appreciate all of your support. It means a lot to me. I hope you're all doing well. And I will catch you in the next one. All right, take care, everybody. Bye-bye.